Kevin Hassett joins us, chairman of the Council of Economic Advisors. Kevin, we haven't heard a response yet from President Trump on the Fed. Is he disappointed they raised rates?
Oh. Well, you know, I think that the Fed, it's an independent agency, and our job is to comment on how the economy is doing. And, I think that the Fed made a move yesterday that markets have responded a lot to. You know, I think as I've watched the discussion today about what the Fed did and how it's impacting markets, I've seen some confusion that I just wanted to clarify, because I think people are getting their economic models wrong a lot in response. Yeah. So the basic idea is that when the yield curve gets flat or inverts, then that historically has shown you that the risk of recession is higher. But that whole literature that looks at yield curves looks at a time when there's no quantitative easing. And so if we were to remove all the quantitative easing all around the world, then the 10-year rate right now would be, according to the Fed, about 100 basis points higher. If it was 100 basis points higher, which is consistent with the 3% growth we're seeing, then of course the yield curve wouldn't even be close to inverted. And so that old literature is not useful right now as a guide to what the recession risks are next year, because the end of the yield curve is being pushed down by QE.
That's fair, but Kevin,
yeah.
There are a lot of other market signals right now that are flashing warning signs about the economy. Oil prices, for instance, in the last 3 months are down 34%. The NASDAQ is now down about 20% from its recent high. The S&P down 16%. So what's that telling you about the economy?
Right. Well, the oil price decline is clearly related to the fact that Asian economies are weak and the European economy is weak. But, you know, right now, GDP now is at 2.9 in the fourth quarter. Last year at this time, you know, I used to come on CNBC last year and say we were going to have 3% growth this year. And a lot of your other guests said we were crazy. Well, it looks like we're going to have 3% growth. And so the fundamentals for the U.S. economy are very strong right now. And you're absolutely right. There's some financial market gyrations, but I think that they're related in part to this global slowdown. And in part, I think maybe to a confusion about this yield curve and what it means, because QE is affecting the end of the yield curve. And that has a big effect on the way you should interpret that literature that says that recession risks are higher.
That's fine. Granted, Kevin, maybe we have to make some adjustments to our interpretation of the yield curve right now, but clearly the markets more broadly are bracing for some magnitude of slowdown in the U.S. economy next year, not strictly because of global weakness as well, right? You have tariffs in there that are interrupting the whole picture in terms of what we can expect next year, downgrades of earnings. We had Federal Express kind of warning on this stuff. So do you think that we are going to have a meaningful downshift in the U.S. economy next year? And is that why the administration has been critical of the Fed at this posture?
Well, look, you know, I mean, on the first part of the question, again, last year at this time, I forecast that this year would be 3.1. And it was based on the fact that capital spending would go up after the tax cuts. If we get about 2.5 in the fourth quarter, which is below the GDP Now estimate right now, then we get the 3.1 that we said. And so I don't really see any reason why I should adjust my forecast of about 3 for next year, given that this year came in as exactly as expected. And so the fact is that capital spending has surged a lot. It slowed a little bit in the latest data, but in part because the guys who produce capital goods are at capacity and having a hard time meeting the high demand. And so that's usually a very favorable signal going forward for the economy. And so I think the odds of getting a GDP growth number next year below 2 are very, very small, given the momentum we're carrying into the year.
But housing has been slowing meaningfully, and all the confidence surveys, including small business, have started to show some weakness. The Business Roundtable survey rolled over. I mean, there are signs of weakening, no question about it. And if you add that to the fact that the stimulus and the tax cuts are going to wear off next year in the middle of this very tighter monetary policy period, what does that all add up to for growth next year?
Well, first, don't forget that all those sentiment indicators you're mentioning, like the Business Roundtable's capital spending indicator or the NFIB survey of small business sentiment, they were all at historic highs, and then they sort of leveled off a little bit at historic highs. And so I think that the idea that there's like a turnaround away from growth is just inconsistent with what we see in the data. And as you know, and as you've noticed with the jobs picture as well, everything's very strong. Wage growth is there. Incomes are growing a lot. We're seeing lots of anecdotal evidence of a very, very strong Christmas. We've had, you know, great sales in the fourth quarter. At CEA, our estimate for consumption growth in the fourth quarter is 4%, which is consistent with that strong income growth. So again, all of that stuff suggests that there's momentum going forward. But if you go back for the last 40 years, then you don't get a recession after a 3% quarter. It just doesn't happen. And we're looking at about a 3% quarter and a 3% year. So yes, I absolutely, you're right to point to financial markets and say that there's a lot of turmoil. I think that some of that is related to the global slowdown, and some of that might be related to this apparent misunderstanding about how to interpret the yield curve right now.
So the S&P 500 is down 16% from its high in 3 months because people aren't really sure if the yield curve is giving them a bad signal, or is it perhaps
no? There's going to be a profit signal. You pointed that there's definitely a profit signal. I think that people are, have been whipped into a frenzy about the recession probability being a lot higher because of this faulty yield curve analysis, and then so the true fundamentals moving markets. But I think that if there were signs that if the jobs number was negative, if retail sales were declining, if we were looking at GDP growth in the fourth quarter of 1.6%, which is what we got for the whole year in 2016, then there'd be a lot more reason to be nervous. And so I think that right now, the Fed just lifted rates because they believe, like we do, that the economy's strong, that inflation pressures are low. They've signaled a couple of more things that they're going to do next year, but that's based on the fact that they believe the economy's strong. And so to flip from that to, oh my gosh, we're going to have a recession, that the world's falling apart, I think is really to jump too far.
Kevin, the president wants to see the stock market go up, clearly. Why now is he threatening the government shutdown, 24 hours to go here, and not going to sign this Senate short-term spending bill? It didn't help market sentiment that was already fretting the Fed.
The president has a very small ask that he's had really since he arrived, that Congress focus, like voters want him to do on border security. And I think that he's absolutely adamant that that's going to happen. We've seen a lot of down-to-the-wire negotiations in my lifetime here. I've been in Washington for 30 years, and it looks like we're about to have another one. But he's got a very, very firm position. And I think that, he's right now engaged in ongoing negotiations to achieve his objectives.
Do you think there will be any economic consequences if the government does shut down?
I think that if the government were to shut down for a really long period, that there are estimates that can have a negative impact on the jobs numbers in the short term. But think about all of the turmoil we've had over government shutdowns over the years. Looking back on it, it seems like we tended to overreact, and economically, it's not something that really has a big long-run effect. But for sure, if we had a long government shutdown, then it might show up in the jobs report and so on.